मार्केट क्या लग रहा है?
One is to be disciplined, and secondly, time in the market is more important than trying to time the market. I'm by nature a bottom-up investor, so every stock has to make sense in absolute. In risk management, the very first protection we have is essentially our robust research system. General discourse is a lot focused on stock selection. I think sizing up is something that I try to pay more attention to. There will be occasions where I will invest into businesses that are either slow growing or are non-leadership.
AI is impacting the whole world. So how much are we working towards automation in our investment process?
We are quite excited about AI. In IT space, there has been demand deceleration close to 2 years. It's difficult to pinpoint when the tide sort of will turn. Negativity is high, expectations are low, and valuations are reasonable. One needs to sort of not have a large underweight on this sector at this stage. When will FIIs return? Why they have book profits and reduce exposure? That is difficult to speak for them. The participation of Indian individual investors into our financial systems or capital market is a great positive.
Hello everyone, welcome to this live session, Portfolio Dialogue with Fund Manager. Today we have with us Amar Kalkundrikar, who is our fund manager for HDFC Multi-Cap Fund and HDFC ELS's Tax Saver Fund. Amar is a HDFC AMC veteran. He started his career with us, spent over 15 years as investment analyst with us. He's back, joined us back recently and has taken over as a fund manager. Amar, welcome to the show.
Thank you, Ram. Thank you for having me.
Okay, to begin with, Amar, the job of a multi-cap fund manager, involves dealing with three separate universes: the large caps, the mid caps, and the small caps. So does your investment approach differ when it comes to deciding whether to go sectoral overweight, underweight, or if you have to decide whether to go top down or bottom up when it comes to dealing with different universes? So what is your investment approach?
Sure. That's a great question to kick off this discussion. But before we sort of go deeper into the how part, I want to talk a little bit about the what part itself. So whenever we talk of investment, what are generally, two big let's say rules that we try to follow? One is to be disciplined, and secondly, time in the market is more important than trying to time the market. This product systematically incorporates both those things. What are we doing here in this category? 25% allocation each is being given to large cap, mid cap, and small caps in a disciplined manner. We are not trying to time the market here. These allocations will be there irrespective of what is the level of valuation and things like that. So in my opinion, this product deserves to be an anchor allocation in the equity portfolio of any equity investor. Now let's talk about the how part. See, stock selection or portfolio construction, there is fair amount of similarity, whether you are dealing with large cap, mid cap, small cap. You basically have to analyze businesses for their what is the size of opportunity, what is my right to win, what is the management quality, cash flow generation, ROC, so on and so forth. And then you try to answer question, what is in the price, what is not in the price. Once you decide that I want to have this stock, then you answer the next question, what is the weight I'm willing to allocate for this. Now this process remains same irrespective of whether large, mid, small. In case of small cap, a few additional things come in. See, the variety of quality among small caps is fairly wide. See, large cap, by and large, their growth profiles will be different, but their resilience by and large is there. They are all resilient, large established businesses. But in small cap, you not only have variation in growth, but you also have variation in resilience of the businesses. Second thing is low liquidity. Because of low liquidity, shorter term trends often tend to get sort of amplified to create excesses both on positive sides as well as on negative side. So that's why when you are dealing with small caps, the importance of risk management sort of goes up. The first, I think, in risk management, the very first protection or mode that we have is essentially our robust research system, which itself ensures a first solid level of filter. Once companies, small caps have cleared that filter, then sort of my role starts. What I also, in addition to our risk process, I look at is I typically avoid companies where or have minimum exposure to companies where certain red flags that I look at. One is typically in small caps, for example, low or no controlling promoter stake, low gross margin, high working capital intensity, These are some of the sort of red flags that I try to pay more attention to in small businesses, particularly small and mid cap businesses. So that's broadly how different approaches are between large, mid, and small. Now, on your question of bottom up or top down, I'm by nature a bottom up investor. So every stock has to make sense in absolute for it to be a part of the portfolio. And frankly, how it fits into a different segment also follows from that bottom up approach. But again, even within that, there are certain principles that I try to follow. In capital intensive businesses, for example, generally preference is to go with large cap names. In sectors where we are seeing a cyclical upturn, or we are, which are sort of in early stage of upturn, typically playing breadth, which is small and mid cap names, tends to provide sort of better outcomes.
You have taken over the portfolio recently. Can you take us through some of the changes, important changes that you have made to the portfolio?
Sure. Again, before I speak about the changes made, I want to speak a little bit about the continuity aspect. See, first of all, as a fund house, we are a research-driven fund house. Each and every stock that gets into portfolio is a buy idea generated by our research team and vetted by them. Irrespective of who is the fund manager, that fact remains unchanged, number one. Number two, I am someone who has spent 15 years in this organization, and I am someone, I started as a research analyst, was a research analyst for almost 12, 13 years here, also portfolio manager, and I'm now back. So in that sense, there is an element of continuity. Now coming to the changes, see, if you see the composition of portfolio now, what we have done is we have increased exposure to consumption, to IT, large bank and insurance, large private banks and insurance, and we have reduced exposure to industrials, materials, and some of the commodity sectors such as chemicals. We have also tried to put more capital behind ideas where conviction levels have gone up.
Let us talk a little bit about the overall markets. I mean, that is in every meeting that maybe a distributor goes or an advisor goes. A lot of our viewers today are, along with the investors, the MFD community has also joined. So typically the first question, market kya lag raha hai? The market question does come up. So take us through your overall outlook as we go into the new year.
If you take any longer period, at least 5 years or longer, what we see is that typically earning growth of Indian corporates is a tad higher, generally in line or tad higher than the nominal GDP growth. Of course, there are, this is not linear. There are phases when, it deviates from that trend either on lower side or on higher side. 2015, let's say 2016 to 19 was one phase where it deviated below that trend line. And last 2 years, that is FY 25, 26, maybe even second part of 24 has been the phase when earning growth has sort of trended below that line. If you look at Nifty estimates, and because Nifty is sort of most widely and consistently available EPS estimates, last 2 years CAGR is sort of mid single digit, whereas 5 years, 10 years CAGR is probably low teens. We have a low base, but that's not the only thing. We have a low base of earnings, and there are a couple of measures that government has taken in the form of stimulus. First is GST reform, second is income tax cuts. If you see even regulatory actions, particularly the RBI actions, they are also now incrementally far more supportive of growth than they were 1 year back. So I think overall, FY 27, in my opinion, looks much better than what FY 26 looked at the beginning of the year. So I'm reasonably optimistic about earnings growth going forward. And typically markets, as we like to say, sort of markets are slave to earnings. If earning recovery is happening, it should be good for market. And this trade deal, as and when they get signed, also will provide an affirmation for towards that thesis.
Sure. So the one side of the earnings growth side you've covered fairly well. The other side is the valuation question. Is it that? So the question comes: is it a good time to invest? So Indian markets, as they say, does trade a little bit of a premium from the historical, especially the 10-year averages. Definitely, the markets are not cheap at this point in time. So that differs maybe a little bit between the large, mid, and the small cap segments also. So request you to take us through that. Also, given the growth prospects, I mean, India is among the fastest growing countries in the world. So, how do you look at the valuations considering that important fact also, especially when it comes to building your portfolio?
Sure. So when you look at valuations, I think large cap valuations are fairly reasonable. They are actually attractive when it comes to large cap. In the small caps, there is a bit of a polarization. Some of the businesses that you would want to own haven't corrected to the extent we would like them to. Barring those exceptions, there has been reasonable correction in the small caps. That's not visible at overall index level, but when you look down, correction has been significant in those names, and mid caps lie somewhere in between. So taken together, I think valuation, there are no major concerns on valuation in my view at this stage from a construct of a product like this. Now, on the relative valuation part, see, historically, India as a market has always traded at a premium to emerging markets for a couple of reasons. One is visibility of longer growth for longer period. Number two, relatively better capital allocation decisions and discipline and ROE profile of Indian corporates. And third is our institutional setup. The fact that we are a well-functioning democracy, our regulatory setup is of really high order. Those factors have always meant higher premium for Indian equities as compared to some other emerging market peers. One factor which maybe 10 years was not so much of a positive but is now positive in my view is also the increased liquidity of Indian markets. So that also one should not lose sight of. Overall, I think in this calendar year, Indian equities have underperformed some of our peers. Um, if you see, FIIs also have been underweight on India now for some time. So I see limited downside to our valuations from current level.
So initially you mentioned your investment style. So when it comes to the overall style, this value versus growth question does come up. So yours, I believe it to be a more balanced one. Is that how you manage when it comes to stock selection?
Yeah, I couldn't have put it better than what you have done, Ram. So look, if I have to talk about investment style, in simple, it is to develop and maintain a diversified portfolio of sustainable businesses, all individually sized up well, and do not overpay for them. Now, let's sort of go a little double click into each of these aspects. First is sustainable businesses. A business has to be at least sustainable. Preferably and normally, bulk of the portfolio comes from growing businesses and leadership businesses. Yet, there will be occasions where I will invest into businesses that are either slow growing or are non-leadership, available at sort of very attractive valuation if I see triggers for some of those factors to recede or change. The second aspect is diversified. So this idea is not to tilt the portfolio in any direction to extreme. Sometimes value does better, sometimes growth does better. I have no energy and ability to predict what is going to work better going forward, but I will have representation of both in my portfolio. I will try to have better and better risk reward within each of those segments. Overall, bias is to own growing businesses, compounding businesses, but I am open to also have businesses which are slower in growing, but where mispricing has happened to a fairly attractive level. So that's I think on this investment style part. Everyone, I mean, we talk a lot about. General discourse is a lot focused on stock selection, but there is very few people talk about sizing up. I think sizing up is something that I try to pay more attention to. If you get great ideas, but if you haven't taken sufficient exposure, it adds very less to the overall alpha. What does it mean? It doesn't mean creating a very concentrated portfolio, but it will also not be a very fragmented portfolio. So optimal sizing is in some sense a subjective art, subject to decision, whatever you want to call it. But sizing up is important. And lastly, uh, we buy businesses. I mean, this is true of HDFC philosophy in general. We buy businesses with a minimum 2 to 3 year horizon in mind. We may end up owning businesses for much longer time, but when we get in, we typically look at 2 to 3 years. And idea is not to churn portfolio much. A portfolio turnover ratio, don't hold me to this, but 15-20% is ideal and sort of right uh, balance in my view.
Great, Amar. Uh, in HDFC AMC, we have strategies running for 3 decades now. Some of them are over 2 decades. I'm aware largely the investment philosophy is the same, but when it comes to research process, we have talented set of individuals in the investments team. I'm sure you are backed by a large set of investment analysts as well. Take us through the research process, like how typically a stock idea gets initiated till the time the stock idea makes its way to the portfolio. Take us through the overall research process of our ecosystem.
We are a research backed or research centric investment team. Research occupies a place of pride, and personally for me it's a topic very close to my heart because in my earlier stint I was larger part of it I was a research analyst. So we have a research team that has acquired significant domain expertise in individual sectors by virtue of the fact that they have covered these sectors for fairly long period of time and over cycle. What do I mean by over cycle? Over cycle means you have covered sectors, same sectors in good times as well as bad times of the sectors. So you have seen all narratives, perspectives that come in and go out, and to that extent you are wizened by having seen this over time. All these analysts are also, I mean, the research team is also sort of supported by access to all possible technology platforms, industry subscriptions, databases, whatever you can think of. You also have access to sell side, and because I mean, we as an institution are so large, we have such a meaningful scale, we get access to not only global analysts of global investment bank, we also get access to experts who are globally renowned personalities on things of interest such as artificial intelligence, electrification, rare earth materials, so on and so forth. So that's the resource rich base of our research process. Now, in terms of research process, typically, it involves firstly it starts with analysis of financial statements, then you do 360-degree checks, ecosystem checks. You try to speak with as much as possible with customers, distributors, competitors, regulators about individual businesses. You meet managements, do participate in quarterly conference calls. You also meet sell side, you engage with sell side extensively, particularly those who have a view different than the view that you are coming to, because you want to know what's the different thinking there. And this all process culminates into research output which is well documented, electronically stores. It results into different kind of notes, and also the ultimate outcome is analysts having projections, estimates, target prices, and ratings between strong buy, hold, and sell. That's roughly our the research process. And once on top of that research process, then individual PMs will take uh, that as base and construct portfolio out of those ideas in line with whatever product templates have been set by typically the investment committee, along with risk management department.
Sure. Thanks, Amar. Let me bring the discussion back to the markets and the portfolio. I've seen a few questions from our viewers, live audience. So, first question is on a few sectors, especially IT sector is an overweight in your portfolio by a little margin. So, what's your overall thought? I mean, this AI question is also coming up in terms of what's the impact on the IT sector, etc. But we've got a reasonable weight in the portfolio. What's your overall outlook on the sector?
If you see in IT space, there has been demand deceleration for last now close to 2 years. There are different reasons. Of course, it started with uncertainty arising out of the plans of the incoming government and the tariffs that they imposed. Then it sort of that uncertainty continued for some time. Then AI related uncertainty has come in. How will AI impact businesses? But in my opinion, the negative impact of AI on coding resources or coding as an effort is what everybody is excessively focused on, while the positive elements of AI, becoming business decisions or AI getting integrated into business decisions is sort of not being given much consideration. I don't know how, and it's difficult to pinpoint when the tide sort of will turn in this case, but I think uh, negativity is high, expectations are low, and valuations are reasonable. All of these companies are free cash flow throwing, high dividend paying companies. So I think, uh, in my opinion, uh, it would be one needs to sort of not have a large underweight on this sector at this stage.
Okay, great. Do we have, I mean, have we started automating processes in our investments team? I mean, there's a connected question, and if AI is impacting the whole world, I'm sure that is impacting all of us today. So, how much are we working towards automation, etc., in our investment process and the research process?
Look, AI is reality. A lot of development is happening there. The commercial applications, use cases are still being tested. We at our end internally have teams working on these projects and are testing different platforms to see which platforms give us consistently usable sort of outputs. Um, and I mean, this can be in the long run a source of competitive advantage for us. I think it is a little premature to talk about this at this stage, but I also want to bring in another aspect. See, data analysis tools, data analysis, the number crunching is improving, but what is also important is we must not lose sight of the fact that interpretation and decision making will remain subjective. And I think that is where the cumulative 200 to 250 years of our investment team come into play. Frankly, I mean, I speak for my all of my colleagues in the investment team. We are quite excited about AI because the more we automate things, more time we are left with to do basic thinking, to sort of reflection, thinking, and decision making. So we are quite excited about AI.
Superb. So, there is a viewer question. The weightage of the banking sector, banking and finance, is on the higher side. I mean, we have a significant weight to that. So, what's your
Yeah,
outlook
sure.
on that?
So in financials, look, we have had a reasonably benign cycle over last couple of years. Credit cost remain meaningfully below the longer term averages, and we have to be cognizant of that. Extrapolation of some of these trends may may turn out, you know uh, can sort of put us in harm's way. So one has to be slightly careful. What we have done is I have increased allocation to private banks where I have I mean, longer term sustainability of these matrices, I think, at least I comfortably feel, is more. So insurance and private banks is where we have increased our allocation, and I think NBFCs and PSUs, where in case of PSUs, credit costs are meaningfully below system average, or let's say below longer term averages. I think that is where we have done some amount of profit booking. So overall, in financial services, we might be close to equal weight or marginally even underweight. But within that, private banks, larger banks, we are overweight. Insurance, we are meaningfully overweight, and we are underweight NBFCs and PSUs.
Sure, Amar. In the initial part, the first two questions, you gave some idea about the consumption sector. We are overweight on the consumer discretionary part, especially. There's been some slowdown in the last 1-2 years on the mass consumption, etc. We have seen a set of government measures, be it the GST, the cut in
Income
interest
tax.
rates, income tax changes, the monsoons were good, and various other things. The policy reforms push is for higher consumption led growth. So, the next 1 year, what's your outlook and how are you going to play? I mean, when it
You are
comes to.
right. The government focus and policy support is now more balanced between consumption and infrastructure, or consumption and investment, as compared to what it was maybe 5 years back, where disproportionate focus was on the investment theme. GST cuts, income tax cut, the upcoming pay commission, these are sort of meaningful triggers for consumption revival that I see on the horizon. You're right. Mass consumption has, see, during post COVID recovery, typically the higher income discretionary consumption has done well. Um, Whereas mass consumption has slowed a little bit in last, let's say, 1 or 2 years. We see signs of some improvement happening there. GST cuts will also come in handy there because it will also raise competitiveness of organized sectors. So in overall, we are optimistic about consumption as a theme, and this theme, the particularly mass consumption, has underperformed broader markets over last 4-5 years, and their relative premium to market has meaningfully come down.
Sure. Thanks, Amar. So there's a question on the FIIs bit. So that's something probably we cannot avoid asking. So for the first time, correct me if I'm wrong, FII holding in the amount in the Indian equities has come down probably below the DII holding. There's been some outflows, significant outflows in the many months that we've seen. So what's your thought? I mean, now the next 1 year, do you see FII flows coming back? What would that have a positive impact on the markets? What's your overall outlook on that?
Sure. So, when will FIIs return? Why they have book profits and sort of reduce exposure? That is difficult to speak for them. But I think we must what has happened in India is remarkable in the sense domestic investors sort of have the flow in mutual fund industry that we are seeing, and sort of resilience because of with that Indian markets have seen is phenomenal. So I think that is a great achievement. The participation of Indian individual investors into our financial systems or capital market is a great positive. It lends to that extent resilience, and resilience to our market. See, about this topic of money going out or FII is reducing exposure, we also have to keep in mind one thing. This is a market that with liquidity by private equity investors as well as FI investors, they should see this as a market where they are able to actually book profits and get liquidity to come out. I think that also will hold us in good state from longer term point of view in terms of attracting future capital. So I am optimistic that FI flows should return, but honestly, it is anybody's guess when that will happen. I hope bilateral trade deals that India is signing up with different countries will also probably help provide some clarity on this topic.
Great, thanks, Amar. I mean, coming back to the fund, HDFC Multicap Fund has just completed 4 years now, has delivered an alpha of nearly 4%, delivering a return of 18%. The reason I am telling you is that typically when investors come in, new investors coming, they have the habit of looking at historical returns. Yeah, 18% is great, but given the nature of our economy going forward from a long-term perspective, especially the expected nominal GDP growth, etc., is there a need for investors to tone down their expectation? Especially there are viewers here who are mutual fund distributors and advisors. So typically, how much is the return? Obviously, mutual fund people, we cannot tell the answers exactly. I mean, mutual fund, the reward comes for coming in blind. I mean, you don't know the return exactly. But do you think there is an extreme need to tone down return expectation, especially looking at the past performance?
So what has happened in let's say post-COVID phase is in a way catch up also on earning growth versus the lull period that we saw in 2016 to 19 phase, which is why earnings also did a catch up with nominal GDP. I think I spoke about this earlier, that earning growth was running a little behind the nominal GDP growth. That catch up happened post 2020, and markets also have then delivered alpha or returns commensurately in that phase. I think going forward from a 3 to 5 year point of view, we have to think in terms of returns being similar to earning growth, which I think again nominal GDP growth is a good benchmark. And again, this will not be linear. There can be times if you see a gush of foreign money coming back, sometimes these returns can be front ended. If you see some other event happening, some geopolitical event happening or oil spiking or something of that sort, you can have these return coming slightly back ended. But I think from a when you come into equities, you have to have that minimum 3-year outlook, 3-5 year outlook. And over there, I think the promise of Indian equities of or Indian nominal GDP essentially growing in low double digit or low teen, I think is still a valid expectation. And frankly, if you see globally also, this is one of the best that you can have across large markets. So um, I think that should be the return expectation. Low teens, low double digit from a 3 to year point of view, CAGR.
Great, Amar. One final question from my side. I mean, you mentioned the post-pandemic, the growth, earnings growth, etc. A lot of this period happened to be the also the time when a lot of individual investors took into the demat culture. I mean, a lot of direct stock trading has also become very prevalent among individual investors. On one side, there is the education about the long-term investing, asset allocation, the SIP, the mutual funds. So what's your message for people who want to do direct versus the mutual funds? What's your one single message for them?
Sure. Um, that's a difficult question because we are interested party. We are part of mutual fund ecosystem, but still I will try to answer that question with all humility and honesty. Look, you as an individual investor, you stumble upon an investment idea because somebody has given it to you as an idea, or you have some association with that company or that industry. You invest in it, you invest some small capital in it, it does very well over 5 year, 10 year. That happens with many of us. There is the question is, can you processize it? Can you make a process of mining different businesses or researching different businesses, creating a template of investing into doing research, investing into businesses, booking timely profits, reinvesting that capital, so on and so forth. Then only you can deploy larger parts of your capital, your hard-earned savings into this. Mutual fund as an industry, or mutual fund as a asset manager company like us, like HDFC Mutual Fund, we have the amount of resources we have to do this precise job is fairly significant. And we have people who are doing this on a day in and day out basis, and this is a very competitive industry. So a close friend asked me this question, my answer to him would be, you are better off allocating larger part of your money to a time tested vehicle like mutual fund, and you of course can learn the art of investing DIY by allocating smaller capital, seeing your performance over cycle, seeing your performance over multiple ideas and not just one ideas, and then as you see progress, you can sort of then decide how do you want to reallocate capital. But I think to start with, that would be my sort of friendly advice. I understand this is coming from someone who is interested in mutual funds, but this is the best I can think of, honestly.
And with that, thank you all for joining in today for this discussion, and thank you, Amar, once again. Thank you very much.
It was a pleasure to be here.
Mutual fund investments are subject to market risks. Read all scheme related documents carefully.